So let me present myself. So I'm Bruno Tissot. I'm head of statistics at the BIS, and I'm also the secretary of the Irving Fisher Committee on Central Bank Statistics. I would like to thank a lot the Bank of Spain because really for hosting this great event and very well organized. I would like also to thank my colleagues from the ECB because I really think that having this series, we already had one before, so it's a second event on external statistics is really a very important thing, and I hope we will continue this, looking forward. I would like also to welcome, especially from this IFC perspective, all the people from outside of Europe that are with us today. I saw many people from Thailand, from Malaysia, etc. I really think it's very important to have this global exchange, even if, of course, we are here in Europe, and I'm very happy that we have also the online connection. Before starting, I would like to emphasize that for us at the BIS, globalization is obviously very important. So we have developed quite a number of statistics to address globalization. So we have data on the global financial systems that we collect with a different perspective from the residency-based statistics of the national statistical offices. We also, and this was mentioned just before, we also promote a lot data sharing, and I think we are quite successful in having global data sharing of financial institutions with many central banks organized in Basel. We also try to have all these inputs to support the policy discussions and to provide global indicators. One example that I would quote is our assessment on global liquidity financial conditions that we conduct at the BIS, so it's for us very important. And we constantly review our statistical offering. So we are constantly changing a little bit, for example, the international banking statistics or the derivative statistics, just to better measure globalization. And I would also like to emphasize the effort we are making with the IMF. You are leading this work on the data gaps initiative because it's really very important, and we really think that all the various phases of the data gaps initiative can help a lot to measure globalization. I think I've spoken too much already, so I would like to first start with you, Stephen Byrne. You are senior economist at the Central Bank of Ireland, and you want to present on international M&Es in the euro area. So the floor is yours. 15 minutes. And we take questions at the end.
Thank you. How do I turn that? Oh, it's okay. Okay, thank you very much. So this morning, thank you very much for the introduction, and thanks to the conference organisers for inviting me here to present this paper on behalf of my colleagues at the ECB. So this is a joint piece of work between the Central Bank of Ireland and the European Central Bank. And let me tell you a little bit about how it came about. So almost all of the co-authors are in some way involved with the ECB's working group on forecasting. So this paper is called The Impact of Multinational Enterprises' Activities on Euro Area Macroeconomic Aggregates and Their Forecasting. So you can imagine, we've heard this morning in particular about Ireland, but about some other euro area countries and the financial flows that are different in these countries. But I'm here to tell you about the real side of it now and the effect that it has on the macroeconomic aggregates. I'm going to focus mainly on the effect and only a little bit on the forecasting, if that's okay. So let me crack right into it. So we know that the activities of M&Es in Ireland are contributing increasingly to domestic output in Ireland. Anyone who's followed the Irish economy in recent years, and it seems like a lot of people in this room have done, will know that. But these transactions have now become so large in recent years that they can also blur real-time signals about the euro area business cycle. And what we show in this presentation is that the work indeed started by Philip in 2015 in the Economic Statistics Review Group in Ireland generates simple statistics in Ireland that can be applied at the euro area level to see through these distortions and better illustrate the underlying trends in these expenditure components. And we show as well that while the immediate within quarter impact on euro area GDP growth from IPP products is broadly GDP neutral, over time, because of these assets are now held in Ireland, these and indeed held in the euro area, these assets are now boosting euro area GDP over time. And this is how you get headlines such as the one on the right here saying that Ireland's wild data is leaving economists stumped. So we're hoping to shed some light to help other economists. So you can see in the chart on the left-hand side here that non-domestic M&Es are an important share of euro area output. For the euro area as a whole, it's just under a fifth, and for countries like Germany and indeed Spain. But if you look at other countries, some of the ones that we've seen already this morning, Ireland, Luxembourg, Slovakia, the share is closer to around 40%. And it's heterogeneous across sectors as well. So it's not surprising to see that pharmaceuticals, the very high value added sectors like computer, electronics, petrochemicals, and machinery and equipment are the big sectors in which these M&Es are dominating. But if I can draw your attention to the Irish bars here in the chart on the left hand side, indeed for both 2019 and 2005, you can see that the intra-euro area share is actually quite small. And that's because what we're talking about here really is US multinationals either setting up a subsidiary in Ireland or indeed, as we heard in some cases this morning, redomiciling entirely to Ireland. And one of the big, so what I'm going to talk about this morning, one of the big activities that these firms are doing is moving the IP to Ireland and indeed holding it on the balance sheet and then exporting computer services to either to their parent or another subsidiary. And those activities then are having very big effects. So you're going to see a lot of big numbers in this presentation. They're having very big effects on Ireland's national accounts and BOP data domestically. So this chart is showing investment of which intellectual property in quarter-on-quarter growth rates, and that's matched by the import of services. So the firms import the services, and there's a recorded investment in IP, and for the most part, those things are offsetting, and the for the most part is important, and you'll see why later. But indeed, it's so big now in recent years, in particular, that it can actually reach a large share of the euro area. So in the chart on the left-hand side here, you can see Irish IPP investment, and in the grey range, you see the maximum and minimum values of the four largest euro area countries. So despite being, in population terms, quite a small country, Ireland is really, I suppose you could say, punching above its weight in terms of IP investment. Now, you might say that since there is IP investment, it's mostly coming from outside of the euro area. The imports are coming from outside the euro area. You might say it's broadly GDP neutral, but that would only be the case within the quarter, because now that as I mentioned, now that the IP sits on the balance sheet of Irish firms, it's now generating substantial exports. So I show here on the right-hand panel the breakdown of Ireland's services exports. We could do something similar on the goods side, but here you see that between 2014 and 2022, the share of services exports accounted for by computer services has risen from 40% to about 60% of Ireland's overall services exports. But this chart doesn't even show that 60% is not showing you that it's actually tripled or even more than tripled over the same period, the total value of services exports from Ireland. So now we have a much bigger number and a bigger share accounted for by computer services exports, and these are a direct corollary of those IP assets sitting on the balance sheets of Irish firms. Now, another way you could look at this is just to say, well, if this is GDP, if you were thinking that this was GDP neutral, then if you were to just net off the investment and the import, then what you should see is a broadly neutral contribution of net exports to GDP in Ireland. But again, I can show you here that this is not the case. So you can see we've broken it down from 2011 to 2014. 2015 is a particular story. I won't go, I guess that's work for another paper. And then from 2016 to 2019, and indeed in recent years, net exports are still contributing massively to GDP in Ireland. But these dynamics now, again, given that they're so large, are now contributing to euro area GDP. So this chart shows the cumulated euro area GDP developments from 2011 up to the most recent data in 2023 Q3, and the contribution from Ireland's GDP to that development. So you can see that over time, what we've begun to contribute. And it also impacts the expenditure components. And we've heard a lot this morning about the interaction between understanding of statistics and policymakers trying to make decisions on the back of them. And nowhere is that more relevant than in the kind of interpretation of the expenditure components of GDP. So a typical example that's come up is the assessment of the euro area non-construction investment. And so if you were thinking particular about the recovery from the pandemic, this might be important. So what you see here is the red bars. I hope it's clear. The red bars are the contribution from intellectual property. So this is at the euro area level, but given the charts that I've shown you already, you can imagine that the contribution here from Irish firms' intellectual property assets is enormous. And so the investment picture at the euro area level is again being driven strongly by the Irish contribution. On the right hand side, we can see the contribution to euro area GDP in quarter-on-quarter terms. The bars are showing you the IPP from Ireland, and the imports of services from Ireland, and the net effect. And while it's broadly neutral, it's also important to see that it's not always. So draw your attention in particular to 2021 Q1. Ireland is again contributing to euro area GDP growth in a strong way. And again, to draw it back to what I said at the beginning, the working group on forecasting, from whom the mandate for this paper comes, wants to look through these developments in order to kind of understand the euro area business cycle more thoroughly. This is an external statistics conference, so I guess I show as well the effect that it's having on the balance of payments just in one slide. So we can say that partly the increase in the services trade balance at the euro area level has been also driven by Ireland. So if you look at the panel on the left hand side, we see that from 2008 to 2023, the euro area's services trade surplus has increased substantially. And looking at that panel as well, you can see that a lot of that is driven by the increase in the surplus in the ICT sector. And that directly is mirrored, if you look across to the Irish panel, by the increase in ICT services exports by US multinationals resident in Ireland. So I've told you that this is a problem now, and hopefully convinced you that this is an issue. But what can we do about it? Well, one simple thing that we can do about it is to use the statistics that are already published by the Central Statistics Office in Ireland. So without getting into a huge amount of detail, the Irish Statistical Office publish modified investment for Ireland, which is, in simple terms, investment excluding investment in IP and in excluding investment in aircraft leasing. And you can see for Ireland that makes a huge difference. In the left-hand panel, the leftmost panel, we see the year-on-year growth rates of non-construction investment in overall terms, in headline terms, and then the modified series, which is almost a straight line through it. It also makes a big difference for the quarter-on-quarter. But when we scale that up to the euro area, we can do a simple exercise where we take headline investment for every euro area country except Ireland, and for Ireland we just swap in the modified series and we weight everything back up to create just modified euro area non-construction investment. And you can see in the left panel on the right-hand side that that's tells quite a different story about euro area non-construction investment. Indeed, it wasn't as high in 2019 as would be implied by the headline figure, and indeed didn't fall by as much. And looking at the rightmost panel, you can see that when you're looking at quarter-on-quarter changes, the sign can even be different. This is very important when you're thinking about a conjunctural assessment of the current state of the investment cycle in the euro area. And this chart just kind of shows the same story in a different way. One of the big discussion points after the pandemic was the recovery of euro area investment. And if we kind of ignore the yellow lines for today, we can just look at the difference between the solid blue line and the dashed blue line. So this is an index, remember, so we're looking at levels. And you can see that there was a very strong build-up up to the start of the pandemic in non-construction investment at the euro area level. And then it plummeted, and then it hasn't recovered. Whereas if we use this modified series that I just discussed, it has, indeed, by the beginning of 2022, euro area investment has recovered. So looking through, to use the phrase of the morning, looking through these transactions to get a more clear picture of developments in the business cycle. So I promised I'd talk briefly about forecasting, of course. I promised I'd talk briefly about forecasting. What I think I've hopefully gotten across is that forecasting these things ex ante is very difficult. These are firm-specific investment decisions that for a forecaster at a central bank is very difficult to predict. Even within the subsidiaries themselves, they're often not aware that these IP assets are coming. But we do need to do something. And indeed, what we can do is to say, once you've had one of these shocks, what can you say about the following quarter? And to be very quick, what I would say is that you could just have a rule of thumb, which is to say, if you have a very large increase in IP, then you just assume that the next quarter it's fully unwound. And that's what's in the rule of thumb bars here. If you were just to take a simple forecasting approach and say the rule of thumb says next quarter it's fully unwound, and compare that with the blue bar, which is the realized data, then it performs reasonably well most of the time. But in, for instance, 2020 Q1, you wouldn't have been correct. This, what we do in the paper, and I won't go into it, is a simple parametric estimation, which is just the IP assets on lags of itself, and some shock dummies, which are dummies for the quarters in which we have these very large IP episodes. Just a simple parameterization like that can give us a better performance, which can be important to generate at least a 1 quarter ahead view of how these things are going to develop. Okay, so to conclude, improvements in statistics have meant that we're capturing more of this stuff, and capturing more of it is meaning that we're seeing it in Irish GDP, and it's knocking on to euro area aggregates and up to including GDP. Modifications of the national accounts data, very simple ones published by the Irish Statistical Office, can help look through those distortions. And while it's difficult to forecast ex ante, we do find some merit in a simple parameterization approach to better capture the unwinding, at least, of those shocks. So I stop there. Thanks so much.
All statisticians in the world have been looking at Irish numbers over the recent years, so it's quite impressive. Let me now turn to Giovanni Donato from the Geneva Graduate Institute, and you want to present international investment income patterns.
Yes.
Please.
Yeah. To be here, and first and foremost, a big shout out to my co-author and supervisor, Professor Theo. And so we are talking about international investment income. Why? Well, as you might know, financial globalization has been a major economic development since the mid-1990s and has led to a large increase in cross-border assets and liabilities. However, one would expect that these movements in position should be reflected by movements in investment income, and especially, higher gross movements in investment income. But this is not really the case, both in gross terms and net terms. And this is what Figure 1 is trying to explain here. So Figure 1 plots on the horizontal axis the net international investment position in percentage of GDP, and on the vertical axis net investment income in percentage of GDP. Now, while for advanced economies there is a stronger correlation, positive correlation, this has somehow reduced over the last decade. Whereas for emerging market economies, this trend is really not there. Like, it's positive correlation, but a bit fuzzy. So what drives investment income? Investment income, that is an increasingly important variable of countries' current account balances. And given that we focus mostly on global variables and US variables, what can we really expect in the current episode of rising interest rate? So these are some of the questions we are trying to answer. I'll skip through this because of time issues. So, what do we do and what we find? First and foremost, we provide some stylized facts on the evolution of primary investment income since 1999. And we document that rising FDI and equity flows have actually been offset by decreasing debt and other investment flows. Other investment flows, it's mostly banking flows. We then perform an econometrics analysis of the drivers of yields of investment income, both at the panel level and at the country level. Now, I will present only the panel results for time issues again, and distinguishing also between advanced and emerging market economies. And we really focus on global variables, and we find that a broad US dollar appreciation reduces FDI and equity yields, and that a higher US interest rate raises other yields, debt yields, and reserves yields. We also find that higher VIX reduces all yields. I won't put this in the main slides, but in the additional slides if you're interested to see it later. However, these panel results lead some heterogeneous effect on net income at the country level, and this is mostly due to the different composition of countries' portfolios in terms of size and composition indeed. We document that a stronger dollar reduces net investment income for advanced economies, but actually raises it for emerging market economies. And for this particular group of countries, we find that a higher short US interest rate raises net income, whereas a higher long US interest rate reduces net income. In terms of interest rate, we find only a limited effect on the 2013 taper tantrum, but a much larger effect in the current episodes. Our paper relates to three main strands of the literature. The first one is on global imbalances in both current accounts and investment position. There has been a refocus mostly in the last few years on stock imbalances. It then relates on the literature on the impact of shocks on current accounts, and the exchange rate here really takes the stage with paper such as the seminal Opsfeld and Rogoff, or even more recently a paper by Kubeda and co-authors that it's central to the IMF external sector assessment. And finally, it actually relates to the drivers of primary investment income and growing literature that once again see the exchange rate being very important, with papers such as Colacelli and co-authors or Behan and Hassan that identify a mechanical valuation effect that will enter our estimation, as well as a paper that I've actually written at the Swiss National Bank with Johannes on the elasticity, exchange rate elasticity of the Swiss current account, and then that it kind of inspired me for other works as well as this one. So in terms of data, we actually rely on the available data from the IMF IFS. So yeah, maybe there will be something to be discussed later. And we take investment income, both in its total and its components, so FDI, portfolio equity, debt, other, and reserves. And in order to calculate our yields, we use investment position for the external wealth of nation database. We then take the exchange rate composition of our assets and liabilities from a database by Bénétrix and co-authors. Keep in mind that these values are only up until 2017, at least for us, and so we keep them same for subsequent year. And moreover, they only distinguish between the total and the debt component of assets and liabilities, with debt including portfolio and other investments. So we actually calculate as residuals the composition of all the other components, and this might lead some measurement error, but that's the best we can do with what we have. So we are left with a sample of 45 countries, evenly split between advanced and emerging market economies since 1999. We use annual data, and we restricted the sample to the bigger economies, and we dropped financial centers such as Ireland for obvious reason then, to have as much as strong panel as possible. So in terms of stylus facts, what can we say? Figure 2 shows total asset income, total investment income flows. And in the blue line, you see the sum of receipts and payments for advanced and emerging market economies, for actually the median country in advanced and emerging market economies. And while we can see that it has increased up until 2008, it hasn't really increased since then. And in terms of net flows, that is the red line on our slides, we see a move from deficit to surplus in advanced economies, whereas emerging market economies have stayed in deficit. In terms of equity, Figure 3 shows portfolio equity, but is the same pattern for FDI. We see rising gross flows in all countries, consistent with globalization. However, in net terms, we see, once again, a switch into surplus for advanced economies, while emerging market economies stays in deficit. And on the portfolio depth side, that is again mirrored by other investment flows, we see for advanced economies a gross flows increase up until 2008 and then a subsequent decrease, whereas emerging market economies in the blue line on the right actually see the opposite after 2008, but a drop in recent years. So in terms of net effects, we have a narrowing deficit for advanced economies and an increasing deficit for emerging market economies in recent years. Now, our econometrics assessment. Keep in mind that this comes from a balance of payment accounting model that I won't put for time reasons here. It's a model with a fixed asset income maturities that mature in 2 different periods. Everything is in US dollar, so that is how we take into account for mechanical valuation effect. So our dependent variable in equation 1 is the log of yields. That is, yields are percent of relevant lagged stock position of investment income and all its components. So there will be like several regression depending on which variable we are interested in. And these are denominated in US dollar. This is a panel regression, and our dependent variable is regressed on its lag. On variable S that identifies the mechanical effect, so the exchange rate between the dollar and the currency of denomination of assets. On a variable Q that identifies the capital gains that are obtained through valuation effect, as well as 2 sets of variables, different variables. X is a vector of global variables, that is the one we are mostly interested in, and includes the US broad dollar index, the US short-term and long-term interest rate, and the VIX. In addition, for receipts only, it includes world real GDP growth and global inflation. Z, on the other hand, is a vector of local variables that include country fixed effect, as well as for payments only, domestic real GDP growth and inflation, domestic inflation. Now, for the subset analysis on advanced economies, we also include domestic short-term and long-term interest rate. Now, keep in mind, this is a panel regression with a lag-dependent variable and country fixed effect that comes from our model. This might cause some problems empirically, but we ran some robustness check with the dynamic panel using the Arellano bond estimator, and the results are really robust across in terms of magnitude, sign, and significance. And we use standard errors cluster at the country level. Now, what do we find? I'm going to put in the slides our most interesting facts, starting with the effect of the broad dollar index. Now, figure 5 shows, and actually all the figures after, shows the effect for all economies, for advanced economies and for emerging market economies on the receipt side and on the payment side. So right now it's gross panel results. And in blue, you can see that the dollar appreciation reduces yields all over the board. And this effect is actually concentrated in FDI and in equity. The effect seems to be stronger for advanced economies, even though if you see in FDI payments, we see an actual stronger reduction on emerging market economies payments rather than receipts. Now, these results are actually consistent with the dominant invoicing currency, because even if everything in trade is denominated in dollars, movements in the domestic currency might have countries incurring loss in profits due to costs being denominated in domestic currency in where they are. Or it can be also due to the fact that a strong dollar in risk of times could depress investment and trade. In terms of the effect of the US short-term interest rate, and keep in mind that this is in level, so it's a log-level regression in this case, we see that a higher US 3-month interest rate raises yields, and these effects are actually concentrated in other payments and reserves, with a negative effect on equity payments. Finally, on the US long-term interest rate, we see that overall it has a limited impact, but it actually raises yield on debt, other investment, and reserve yields, while also increasing yields for FDI and equity payments in emerging countries. Now, these sets of results gives us first an interesting fact that it's like, depending on which variable we are looking at in international investment income, it reacts differently to different variables. But most importantly, we actually see that the effect on both receipts and payments usually have the same sign and the same magnitude. So what can we actually say in terms of net effects? Now, it might be that this effect actually cancel out in the end. And this is what we are trying to do after. So we combine our fitted results with the average positions for each country on each component. We add them up for receipts and subtract the payments, and then we get the net effect in terms of percentage of GDP. Figure 8 shows the impact of a 10% dollar appreciation on net asset income, and we can see that a stronger dollar lowers yields for advanced economies and has a negative effect on the balance, but it actually has a positive effect for emerging market economies. And this is due because payments are actually reduced by more than receipts. In terms of the effect of a US short-term interest rate, we actually see a limited heterogeneous effect for advanced economies, but emerging market economies see a higher net income. And finally, for the effect of the US long-term interest rate, there is a moderate increase in advanced economies with some exception, but a general decrease in emerging market economies. We also performed 2 case studies. I don't know how I'm doing with time, for the taper tantrum and the current cycle of rising interest rate. We use 2012 and 2021 as base, and using our panel results, we try to estimate what actually changed. So the taper tantrum was characterized by a rapid increase in the long-term rate, but not in the short-term rate. And actually the effects are pretty heterogeneous across the board, it's working, yes, with a more decrease for emerging markets than advanced economies. Now, figure 15 shows both fitted and actual change in red. So you can see that our estimates are not really consistent with actually what happened in the change of investment income over GDP. On the other hand, the current cycle of rising interest rate gives us a different picture, with emerging economies being positively affected, and advanced economies being somehow negatively affected. But as time goes on and as interest rate hopefully decline, we see an actual improvement. Now, we also finally perform an exercise with advanced economies only that include domestic interest rate as well. And actually domestic interest rate appears to be worsening net income, even when combined with US interest rate, as you can see from the graph on the right. All right, we're already at the conclusion. What do we see? We see that financial globalization should have boosted the role of primary investment income in the current account, and this is indeed the case for FDI and equity, but not really for debt and other investment. And this appears to be due offsetting trend reduction in interest rate. Our panel analysis, and I stress again, these are just our panel analysis. The country analysis in the slides is actually gives similar results, but higher in terms of effect, gives contrasted effect not only across economic groups, but also across the type of assets that you're looking at. We actually see a similar impact on both receipts and payments, but this leaves a contrasted impact on net asset income. And this is actually due to the fact that countries have a heterogeneous assets and liabilities composition and size as well. And finally, we conclude that we have a limited impact of higher rates in the taper tantrum, but a more pronounced impact in the current phase. Our paper contributes to a growing literature on investment income flows, and in terms of future work, I guess it's mostly related to data, as we are seeing from previous presentations, both in terms of currency composition as well as this nationality versus residency component of our data. Thank you very much.
Many thanks. So perfect, on time. And then we will have time for questions because very interesting conclusions. Let me now turn to Simone Arrigoni from Trinity College in Dublin. And you want to discuss households and international financial integration. So, floor is yours.
Is it working? Yeah. Okay, so we slightly edited the title recently. First of all, thank you very much to the organizer for including the paper. This is joint work with my PhD supervisors, Agustín and Davide, and Tara from the Central Bank of Ireland, who is here in the audience. So let me start off with the introduction, so the motivation of this work. And the motivation starts with the fact that international financial integration, as we have seen, varies across countries and over time. However, most of the papers in the literature have looked at an aggregate perspective, mostly because we didn't have many disaggregated data so far. So either they looked at difference between sectors or between countries, but there isn't much looking into the differences within sectors. And what we want to do is especially focusing on the household sectors. To answer a question like how do households' portfolio differ and what explain these differences and how different households are affected differently when a shock happens. And this is relevant because household finances, they are important for the macroeconomy because household decisions, they affect aggregate outcomes. And given that the role of household is via holding of financial assets is less well understood, we want to focus on this sector. So what we do in this paper is that we study the link between international financial integration and the household sector heterogeneity between and within countries in the euro area. And the core of this presentation will be to explain this methodology that we provide to combine two data sets. One is the security holding statistics to get financial information on investment, and then household level data from the HFCS. And then I will show you how we can use this augmented data set for some research and policy application in two illustrative examples. So regarding the data, I don't think I have to talk too much about the security holding statistics. I think most of you will be familiar with that. It was also in the paper that Martin presented. So this is a Eurosystem database that collects security by security information with information both on the holder side and on the issuer side. And what we are especially interested in for this work will be valuation components of these securities, which we can have information on the prices and on exchange rates valuation, and then the asset type. In the end, we will consider the three instruments which are in SHS, which are investment fund shares, debt security, and quoted shares. The second database we use is HFCS, which is a cross-sectional household level Eurosystem survey, which collects information on wealth, income, consumption, and to complement the first dataset, we are interested in financial assets, and with the three same asset classes that SHS considers. And just briefly on the survey design, there has been 4 waves so far. The one we use is wave 3, 2017-2018. The survey is ex-ante harmonized to allow for comparison between countries, and households are weighted according to population, and there is an oversampling of wealthy households. So let me spend some time now on these what we call these augmented data sets. And first I want to understand why we will need something like that. And this is based on two motivations. So the first one is that in SHS we have all this detailed information on security holdings at the sectoral level, so it's very detailed and very precise, but we don't know much, actually we don't know anything about who holds these items. So if we have the household sector, we know that at the end of a quarter, Irish household will have an X amount of this security, but we don't know who actually within the household sector owns them, which is instead the type of information that we will get from HFCS. So we will have information on household characteristics, quite detailed and a broad set. But instead in HFCS, we don't have information on valuation, on returns, and risk components of from this. So that's why the goal here is to merge the asset characteristics from SHS into the household characteristics from HSCS, in sort of having a combined view on both of them. The rationale for merging is that when we compare the two data sets, we do notice level differences between HFCS and SHS. But if you look here, when we look at how the portfolio is composed in countries, we don't see much of the difference between the split of the instruments, and this will be the rationale on why we can merge the data sets. And now I want to show you step by step how we actually do this merge, which will be in 3 steps. So the first step is we start from SHS and we compute valuation rates. So this will be quarter-on-quarter valuation rates as valuation amount over the stock amount the previous period times 100. And we do it for 3 types of valuation. So we do it for market price valuation, exchange rate valuation, and then total, which will be the sum of the 2. And just for illustrative purpose, here we report the distribution of these 3 types of valuations. And I guess what I want to show you here is that how you can see from a magnitude perspective, most of the evaluation, so the most important component is actually the one related to changes in market price rather than exchange rates. The step 2 is to take now these valuation rates and compute summary statistics. So we'll have mean, median, standard deviation, and the 2 tails, so the 5th and the 95th percentile, and merge these into the HFCS. So the assumption here is that every household in a country will invest in the same pool of security within each asset class. So let's say all the Irish households, they will invest, if we consider equity, they will all invest in the same securities, which is the best that we can do as an assumption. But then we have anyway heterogeneity, because from HSCS we can have household level specific portfolio shares. And this will create heterogeneity, because if we have 2 households in the same countries, they will invest in the same pool of security, but then one will be more exposed to equity, so his returns will be more driven by that, while another household will be more exposed to debt, so his return will be more determined by that component. And just we do a couple of sampling, so we focus on households that holds at least 2 of the 3 asset classes, so that we can see some sort of diversification, and we consider countries which have at least 50 households. So this will leave us with 10 euro countries and roughly 5,000 households. And then the third and last step is that we compute return and risk statistics based on this merge that we did. So the return will be a weighted average of the SHS returns, and the weight are the household-specific portfolio shares. And so this will be for the return, and then we have 3 measures of risk. So one that is based on the standard deviation, that will be a measure of risk on an ongoing basis, and then we have 2 tail risk, which are based on the 2 tails of the return distribution, which measure more how the portfolios perform in case of negative shocks or positive shocks. And this one is to just give you a visualization of the database. So these are cumulative distribution functions. So if we look at them, we want to see how valuation rates and the risk associated with them compares between and within country. So for example, if we take Spain and Ireland Here, what we can see is we can do a comparison between the two countries. So we can see that Irish CDF is more towards positive and higher returns compared to Spain, but also Spanish households, they are less exposed to risk. But then we can also do a comparison within the countries, because we can see that the CDF for Spain is wider in length. So it means that there is more heterogeneity compared to Ireland, which is more shrinked. Okay, so what we do now is we just want to illustrate what can be done with these merged data sets. So this one, just take it as an illustrative example. Is not meant to be a paper per se on education. It's just to take one characteristic. We chose education because now what we can do is to use household characteristics to basically rationalize these returns and risk. So we take education because it's important for portfolio choices. So it relates on the whole financial literacy literature. And we divide in two groups. So the low education, which will be households where the reference person, which is the most financially aware person, has non-tertiary education, and then those with tertiary education. And we do one non-parametric application in which we will look at CDFs, and one parametric which will be based on regression model. So let me start with the first approach, which looks at cumulative distribution function, and let's take Ireland as an example. I guess so the takeaway here is that, so what we can do is to compare these two curves and basically use the concept of first order stochastic dominance to compare the groups. So what we can see here is that households with higher education will have access to higher returns on average, and this is mostly driven by market price returns. And then in terms of risk, most educated households, they are more exposed to risk, and if we look at the tail, they receive higher returns when things goes particularly well, so with positive shock, and but they also bear more the cost when there are particularly negative shocks, and this one is basically what I've just said. And then to the question, is Ireland an outlier? We actually look at these things from a euro area perspective, and we see a similar pattern there. The second approach is, so the motivation for the second approach is that these CDS methodology is very powerful because it allows to look at the entirety of the distribution and not just a point estimate. But when you look at a panel of countries, it might not be, especially when you want to consider additional conditioning factors, might not be the best approach. And so what we do here is to generalize the analysis. We run a panel regression model in which we have our returns on the left-hand side, which are now quarterly. So now instead of using the average over the period, we take, for example, the average return in SHS every quarter and do the weighted average every quarter. Then we have the education dummy, so 1 for high education and 0 for low education, and we add a set of macroeconomics control. So we have 10 countries, roughly 5,000 households, and now 16 quarters. And this is what we get, which is broadly in line with what we got from the non-parametric exercise. So we have the link, education returns, positive link. We have market prices being more relevant in driving returns, while exchange rates are not significant, which overlaps with the fact that the high and low education CDFs in the previous approach, they were crossing each other's. Okay, so let me conclude by saying that with this work, we contribute to the literature on households and international finance by building these augmented data sets that combines these two sources of data. And this data set will allow us to better understand the links between households and international finance with main implication for policy. Then we took education as an illustrative example and showed a positive link between household education and portfolio performance. And maybe this is the most interesting point is, so this type of analysis will encourage further exploration on other dimensions and also serve as an input both for academia and policy making, we've looking at the combination of the two data sets for policy, for example, to mitigate household risk exposure or promote responsible financial behavior. Okay, so thank you very much.
Okay, many thanks, Simone. So you show that education matters. So all the parents will have something to, when they go back to the family after the conference. Okay, let me now turn to you, Gian Milesi Ferretti. I will not present you after your IMF career, your work on these issues with Governor Land in particular, but now you are working with Brookings institution. The floor is yours.
Let me start by thanking the organizers, BIS, the Irving Fisher Committee, the ECB, and especially the Banco de España for its generous hospitality for having me here. It's really a trip down memory lane, a bit because of the audience, a bit because my first teaching was done at TEMFI back in 1992, so I have a particular affection for Banco de España. It really goes back to the beginning of my career. And of course, as Bruno just mentioned, there's half of my CV sitting there on the first row. And a lot of the work I'm going to present relies heavily on the work that Philip and I have done over the years. Let me also mention that in the audience there are people that have been extremely helpful in preparing this work. Carol Berthaud, who is my source of knowledge about US data in great detail and specific countries, and Carlos Sanchez Munoz and the whole team in statistics at the IMF, who have been always super generous with their time and insights. So now to the substance of the paper. Looking at this database that Philip and I maintain, that is heavily based on international investment position data published by disseminated by the IMF, you see a very large discrepancy between global portfolio equity assets and global portfolio equity liabilities. The chart you see has the sectoral breakdown of the international investment position. I have aggregated the debt categories because reserves are a part in other investment and part in debt securities, so I have aggregated the two, and everything is scaled by world GDP. So you see the bars tend to the negative, the world is a net debtor, and you see from the blue lines that historically and persistently the biggest component has been portfolio equity. This is how I'm going to structure the presentation. I'm going to talk briefly about data sources, say how we identify missing assets. You have the sequence of the steps there. And finally, once we have identified this gap, I'm going to use this bilateral liability information for the countries that we have identified as being those where some of the foreign holdings have no identified residents attached to it, and those are the US, Ireland, and Luxembourg. And from those data, we sort of try to understand better where those assets, if not held, where they are traded. So these are the standard data sources. There is nothing confidential here. I was actually able to get very recently some unpublished data from the CSSF in Luxembourg, the Comité du secteur financier, supervision, je crois, c'est comité supervision secteur financier. They are the supervisors of financial institutions in Luxembourg and have data on investment funds that was instrumental in helping me present something a bit more substantial for that country. So here's the approach to identify where the missing assets are. So we have these sums, global assets, global liabilities, and we see the liabilities are higher than the assets, but how do we go about it? So we use the Coordinated Portfolio Investment Survey that reports the geographical allocation of portfolio equity assets for virtually all, not all, but virtually all major investing countries. It is a fantastic resource. And what we do with this data? Well, we aggregate the destination countries and we compare the amounts that investors are claiming in the aggregate to be holding in different jurisdictions with the liabilities reported by such jurisdictions. And we identify the countries for which the differences are the largest. And then we do a bunch of corrections to narrow this discrepancy, and then we are left with something, and for that something we're going to look at bilateral surveys of liabilities. Remember, most of the CPIS is about the allocation of assets, closing the circle requires comparing the data with the bilateral data on liabilities. So I'm sorry for presenting tables with numbers, but maybe next time I'll try a graph for this one. So these are the broad numbers. To give you a sense of scale, here the numbers are in billions of dollars. Think of global GDP is about 100 trillion. So when you see there the global portfolio equity liabilities are about 43 trillion, we're talking about over 40% of world GDP. So that's what comes up if you aggregate what countries are reporting in terms of liabilities. The lion's share of that you will find in the IIP. A few more numbers you can find in our database, and they're based on a variety of sources. When you compare to the liabilities that you derive from the CPIS, about 37 trillion, you see a difference of about 6.5. And you go country by country, and you see fundamentally that there are three countries you have to look at. And those are the US, Luxembourg, and Ireland. The US is not surprising if you think it's a very large fraction of global stock market capitalization. Not everybody participates to the CPIS. Whatever reserves central bank hold in equity are likely to be heavily skewed towards the US. Those would not be in assets. But for Luxembourg, so you would expect a larger gap there. But Ireland and Luxembourg are interesting cases. And again, Martin illustrated the very same point on the data for these two countries in his presentation earlier this morning. So I showed you the liability side. So how about the asset side? So the asset side, of course, if I had just the CPIS, I would have this gap of 6.5 trillion. But we know that CPIS is not complete, and the difference is basically twofold. You have some countries that do not participate, and some countries where participation is partial in terms of reporting. Starting first with the non-participants, you have primarily sovereign wealth funds in the Middle East, and you have a couple of smaller offshore jurisdictions, as well as Taiwan, just because it's not an IMF member. So you have there the figures that are very, very, very rough estimates of the assets of these destinations, except for Taiwan, which actually reports an IIP, so you know how many portfolio equity assets they have. So summing up these figures, you basically augment the assets relative to CPIS by about 1.6 trillion. And then you have CPIS reporters that don't report the whole thing. The main one is the Cayman Islands. They report investment fund data, but not all sectors of the economy. And also for investment fund data, the reporting is broad but not complete. What you see there is a correction of $700 billion, a pocket change. And that comes primarily from looking at what the US says the Cayman Islands investment in the US is, and compare that figure with what the Cayman Islands report. So that's where that extra information comes. And the second is Kuwait. Kuwait excludes the sovereign wealth fund from its equity holdings, which is basically excluding 95% of the assets they hold. Again, this is a very rough estimate, but so be it. That's what we can do for these countries. So you close another chunk there, also of about 1.6 trillion. So in the end, the gap that between assets and liabilities is not the 6.5 trillion that I had before, but is reduced by this sort of enhancements, if you want, to CPIS figures. So we are left with, you see, 40 billion here in assets, 43.5, about 3.5 trillion missing in 2022. So I now turn to the liability surveys of the three countries that we have identified as being those where we lack knowledge about the residence of some of the investors. The first is a chart for the US. Here I report figures in billions of dollars, and I look at the gap between what the US reports its investors to be, its foreign investors to be, and what you can glean from CPIS. And I classify countries in 4 buckets. The first one is no CPIS, so countries that do not report to the CPIS. Second is CPIS under-reporters, I already mentioned. This is basically Cayman Islands and Kuwait. Then you have financial centers. You have typically a custodial bias in these calculations. So when you do a liability survey, you know who the first holder of the asset is, but that holder is likely to be in a financial center, and he may be holding the asset on behalf of a resident of another country. So if you look through the chart, you see that you have a number of these categories that are particularly important, and financial centers, of course, loom large. And if you go country by country, I report here the difference between what the US reports and what the investor country reports. You see very large numbers, particularly for the UK, which is here again, with thanks to Carol, is aggregated with Jersey and Guernsey. And you see relatively large numbers for Switzerland as well. But the list is mostly about financial centers, with a couple of countries where you have big central banks with a lot of reserves, which may well be accounting for the fact that some of the equity investment in the US is not captured in portfolio equity assets of the declaring country, because holdings by a central bank would be classified as reserves. And this is just a very quick table on holdings by central banks of equity. And the first 2 lines, holdings by central banks and international organizations, comes from this survey that is conducted in conjunction with CPIS, that identifies holdings by central banks and international organizations. And you see that about, for 2022, is 400 billion, of which half of it, or a bit more, over half, is in the US. I have used data on reserves by in equity by the Swiss National Bank. The line on world is from their own statistics. And the second line, I've just assumed brute force, that the share of equity investment is the same in the US, is the same as for the survey conducted together with CPIS, of which Switzerland is a big component. And so you see that probably about 100 billion extra in equity by Switzerland can be explained by central bank holdings. You still have this huge gap for the UK. We turn then to Ireland, and this echoes, or it's actually the same data that Martin showed with a bar. I showed them in a table. If you aggregate investment funds, non-money market and money market investment funds by Ireland, they report data on an immediate counterparty basis on who is the immediate counterparty to which these assets are sold. 1.7 trillion are sold in the UK to a UK entity, and the UK claims to be holding about 400 billion. So the gap is 1.3 trillion. I mean, this is real money, and it's very consistent with the set of data we've seen for the US. You see, the investment funds and money market funds are just part of total portfolio equity liabilities of Ireland, yet they account for more than the total that CPIS reports, although CPIS coverage is supposedly broader. So we miss a really big chunk of knowledge, a big chunk of holdings. We really miss, we really don't know who the residents are, but now we know from this where these assets are actually traded. I show the data for Luxembourg is only for 21. I now have data for previous years. I just got it 2-3 days ago. I didn't want to do a sort of a wholesale change here. The characteristics, the time series is basically consistent with the data for 2021. What we have here for Luxembourg is a bit more limited than what we have for Ireland. This is not immediate counterparty basis. It is the country where the funds are sold, commercialized. And again, if you look at the data, you see that for the United Kingdom, the reported holdings of portfolio equity instruments issued in Luxembourg is about 180 billion versus 890 billion sold in the UK. And so this is fundamentally what the bottom line is for the role of the UK in this gap. It shows the same numbers I've shown you in 3 separate tables in the form of bars, and you can see the 600 billion gap for the US, the 1.4 trillion gap for Ireland, and the 600 billion gap for Luxembourg. So if you do a quick mental math, you see that we're getting to an overall gap which is getting close to 3 trillion. So that's about the size of UK GDP. So again, very large figures. What we know is that some of these holdings are likely to be UK holdings. Apparently, I'm very happy if there is anybody from the UK that is able to provide some further elucidation, some further information on this. But coverage of money market funds in UK holdings of portfolio equity is apparently not very complete, and those loom large in both Luxembourg data and Irish data. When I say they loom large, I mean that a lot of these money market funds are sterling money market funds traded in the UK, very likely to have a UK counterpart, so you have clearly something missing there. But the magnitude of this is clearly not just the money market fund, something else. It is very likely, the UK is a big financial intermediary, that there are holdings on behalf of residents of other countries. The orders of magnitude I still find staggering. You think that even if there is substantial external wealth management done in the UK on behalf of foreign residents, the total numbers here are very large. But I think this type of work points clearly to the benefit of having reporting on third-party holdings, because if UK statisticians only think, well, this is an Irish fund, is held by a non-resident, is beyond our remit, basically our knowledge stops there, because foreign statistical agencies are just unable to capture this type of information. And of course, I don't need to elaborate on the usefulness of having this information, ranging from literally tax compliance to just a better understanding of spillovers across borders. I'll stop here. The conclusions are basically something I've stressed from the beginning. Thank you very much.
Many thanks, Gian Maria. So it's fascinating to see you have hundreds of billions going here, appearing here. It's always interesting. So now we have almost 30 minutes to answer questions. So I open the floor. I would say present yourself before asking the question, but in your case it's perhaps a bit difficult because everybody knows you. But please. But, micro. Or you can try without the mic, and I presume we would.
I can try, but
because online.
Thanks, Bruno. My name is Bert Kroese, Chief Statistician of the IMF. This was a great battle, and Gian Maria, we really need to talk. I think we can improve our CPS by means of these interesting analysis. And Carlos already told me we're in contact, so that this is great to see what we can do. I have a question for Stefan on Ireland. I mean, after 2015, we all looked into the role of M&Es in GDP, and you made this DNI star in Ireland. But another thing that came up is that it's so important to share information on M&Es internationally. And in Europe, we started this European Group Register initiative to profile M&Es, so at least parts of the M&Es are allocated to countries consistently. And there was some discussion also to exchange information on M&Es. Well, this morning we also heard that it might be good to have some single reporting by M&Es. I'm just wondering, where are we in that process in Europe? And the other question is, well, multinationals don't stick to Europe, so how do we ensure we get consistent information also on that outside Europe, for example, the US, China? Thank you.
Collect a bit more questions, please.
Thank you, Cédric T. from Geneva Graduate Institute. I have a question for Simone. So maybe I'm pushing you beyond the data you have, but just think, do we have information about holding through pension funds? Because in some countries you have capitalization funds that include actually also lower income. And also, do we have information about the extent to which people actively trade? Because if I understand right, what you look at is a buy and hold portfolio. But higher income people often are more active in trading, and that involves fees. Thanks.
Thank you. Other questions? Yeah, please. Sarah.
Thank you. Sarah Barahona from the OECD. I have a question for Gian Maria first, I think. My question is, you're looking at the role of the UK in particular, and I noticed the figures were for 2021. I'm just wondering about whether you've looked at pre-Brexit, because I think there is potentially a Brexit effect. And so I was just curious about that. And then, Simone, I was very interested in your bringing together of these two sides of things, the securities holdings database and the household distributions. And I just wondered, you're looking at the risks that households might face, but I'm just wondering whether you've looked at any situations where there has been a big change in valuations and what the impact might be on the different household groups. Thank you.
Many thanks. A few more. Oh, we will have a second round, so you can think about it. But perhaps I can have you a question for you, Giovanni, because I don't think there was something for you. So can you a little bit explain your conclusions that you have advanced economies moving from surpluses to deficits, and how it fits with your view of the globalization and catching up of emerging market economies? Okay, so let's start perhaps in the reverse order. Gian Maria first.
So, yep, very happy to. Oh. Yes, very happy to talk. I think again, CPIS is, I think, an absolutely fantastic resource, and I know a lot of work is ongoing to broaden its scope. So it's great to swap more notes on this. I think that this is a great question. The Luxembourg data, I showed 21, 22. Luxembourg data, I only had 21. I now have previous years, so I can go back. There is a trend in absolute terms, which comes from the fact that the discrepancy tends to be broadly proportional to stock market valuations. Again, it fluctuates from year to year. And so it's been clearly steadily increasing because also as a share of world GDP, because world stock markets have been particularly because of the US, have been going up very sharply. But I do have data from Ireland, which dates from before. For the US, there is a long time series, and now for Luxembourg, I have it. And so I will be able to report on that and try to make a correction for this valuation issue to see whether this has increased since Brexit. I think is again, a very good point. Thank you.
Also, just in case there's Professor Till that can help me with the answer, just to be sure. So if I can maybe try to answer that, and then Professor, if I'm saying something stupid, you get in, basically. And I think most of our conclusions are actually that there are trends that are, driven by literally different components of investment income. No, so you see for our subset of advanced economies that move in a certain way because some specific components react in a specific way, and also you need to check at the receipt side and the payment sides, right? So the results are really heterogeneous in this sense because it's very difficult to just conclude that if this happens, this will go in a certain way, because you just need to look at country's composition. Now, advanced economies appears to be more in surplus because, like from the status facts, you have these reductions, right, in capital flows, and especially the portfolio side that was discussed, whereas emerging markets maybe have a more FDI based. So I think it appears to be that globalization is maybe going a bit more on the FDI side for emerging market economies rather than for advanced economies. I don't know. These are my takes. I don't know if Professor has something else to add.
Thank you. Yeah, just to complement what was said. Okay. So first of all, the thing that really striking the data is how heterogeneous it is. Yeah. So what we show is a median, but if you do the interquartiles, one aspect that can be is, with a period of low interest rate, to the extent that advanced economy are issuer of relatively safe assets and appetite for bonds, and they would be benefiting from that trend. But you can definitely dig up at the country level and find a very broad and heterogeneous situation.
Okay, so thanks. I mean, what I would say, what I would say is that the elephant hanging over my whole presentation is ESA 2010, and the change between ESA 2010 and 1995 to the concept of economic ownership and the effect that that's had on the compilation of national statistics. And I think, when you're talking about M&Es, it goes a lot of the way. But the problem is then when you have things like redomiciliations to Ireland or subsidiaries where all of the IP is held. And for that, what we've got then is essentially a data gap, right? We know that the firms live in Ireland, but really the ultimate investors in the firm are abroad. And I guess what's gone some of the way to that is again, to mention the Statistics Review Group in Ireland, we've got gross national income on a modified basis, which tries to account for that. And I know as well that the Irish Statistical Institute are really proactive in the the UN statistics working groups and things like that to kind of bring forward I would say constructive solutions to these problems of interpreting the statistics. So in terms of where that is, I don't think I know, but I guess all we can do at the moment is to try and take the statistics as they are and try to interpret them in as best a way as possible, and then to, I suppose, what our project is doing is to kind of highlight these issues such that when we come to the next round, these issues are taken on board. Thanks.
Simone.
Okay, so thank you both for the interest and the question. Regarding Cedric's points, so the first one, yes, it's definitely something. So for now, we kept it very simple. So this is direct holding. So it's the household sector. They directly invest in these things. But there could be some indirect holding, like through pension funds or investment funds more generally. And I'm not sure we can, I don't know if any of you here that is familiar with the data set knows if there is a way to connect the things, because we do have in SHS the pension fund and investment sector funds, but it's more their investments. So there is no clear way on how to link the two. Maybe it's possible doing some assumption, but it's something that we will look into that. And the second question I did, I'm not sure if I fully got it. So you meant like how many of these households they actively trading? There is no specific questions in the survey, so we don't really know that. We can look whether there is something, but like broadly, I'd say no, because it's mostly asking them like the amounts that they hold and whether. But I think there is some questions on like whether they are familiar with risk, whether they like to take more risk or less. So maybe we can infer something from that. But like there is no direct, like they're not asked like, do you currently actively trade? And regarding the second questions, yes. So there's something that we are discussing because we. So the way we showed it here was we took the survey in the third weight, 2017-18, and then we computed the valuation gains for the after period, so keeping the demographic information as sort of like pre-returns information. But we can potentially, given that we have these valuations quarterly, then we could potentially use the different waves and keeps the share constant, and then do something more time series oriented. So looking, for example, some episode of large valuation gains and see how this impacts differently. That's something that we are discussing, but we have not done yet. It's this very preliminary, so it's more illustrative for the moment. But thank you very much.
Okay, so we have now 15 minutes left. So if you want, we can have a second round. Caroline?
Very much, Caroline Willeke, Deputy DG of Statistics in the ECB. I have also a question for Simone. Of course, your results of linking, first, I think it's great to link the two databases, and I hope to see much more also use of the HFCS in linking with various of our other granular databases. Now, on the possibility to generalize your result, I have a couple of questions. The first one is whether with respect to this link to education, did you control for other factors that could also have an impact on your risk aversion? So, for example, the income of the households. Then I was wondering in how far the fact, if I remember correctly, you focus on households that invest in at least 2 out of equity, debt, and investment funds. Now, I think this brings you anyway to restrict the households. They must all be in the very wealthy deciles. From, if I'm not totally wrong, that of course also, let's say, is a bit. I was wondering whether you could, for example, do it by also releasing the 2 to just 1, because if you have maybe more households that only held investment funds, I guess you would broaden the sample and also have more interesting differences than between the households. So I think there's a lot of potential probably for further interesting work. So thanks again.
Thank you very much. I'm Peter Bahaji from the National Bank of Hungary, and this and the previous panels were very interesting for me because we are very interested and familiar with the phenomenon of financial intermediaries, especially special purpose entities, and we also struggle with looking through these special purpose entities in our figures and analysis. But my question is mainly for Gian Maria, because it was a very interesting presentation, like the others in these panels, that in international data reports upon international statistical standards, assets and liabilities for the same instrument may be reported at different prices. It is the creditor and debtor approach, and maybe the assets should be reported mainly at market prices, but the debtor should face the nominal price, the nominal sum which should be paid back. So maybe your conclusions will not modify, but do you analyze, do you investigate this price effect between the asset and liability side? Okay, thank you very much.
José Maria. José. Micro for José Maria Serena.
Thank you. José Maria Serena from Bank of Spain. So I have a couple of questions for Simone. So the first one, I think, relates to the one previously put forward by Cedric. So I think it will be very interesting and important to understand how households gain exposure to securities. So I think in some countries it's more difficult for households to directly buy bonds, not equity, but bonds. And precisely because of this, it could be that part of the exposure they are gaining is recorded as perhaps an investment or asset held in a pension fund, or assets held in investment funds. So you are capturing the second one, but perhaps you are missing the first one. And the second question relates to the way of you interpret the results. So far you are assessing whether literacy has an impact on the excess return households get on their investments. I think it will be very interesting to look also at the volatility of the returns, to see if they are really outperforming households which have less literacy. Otherwise, it may be a bit difficult to draw policy conclusions from the results. But thank you.
Okay, many thanks. So, one question.
Thank you. This will be for Giovanni. I know that you focused mainly on FDI, but I just wanted to comment on last month's issues of bonds for emerging markets. Mexico broke records, and after Mexico, after that issuance of Mexico, many emerging markets, multinationals, also had record issuances. I'm talking, you had never seen that. Now, would that be consistent with what you have been talking about, the appetite for emerging markets? Or do you see this as an anomaly, or where would the trend go, or if you have any comments on it? Thank you.
Okay, we stop here with the questions. I think you don't have questions, Stefan, so I may add one. One it would be any reflection on economic ownership issues, and since you were saying for the next round of methodological changes, and since you have the IMF, the ECB, the OECD there, any comments? But perhaps Simone, we start with you.
Okay, so thank you, Caroline, for the points. Yeah, these are like definitely true. So like the sampling we have done is a starting point, but of course income, wealth, they are correlated with these things, and we're currently haven't looked into that because in the end already like within the country, even without splitting by income on wealth side, already financial assets, they are, at least what we see from HFCS is that portfolio is mostly real assets, even at the top. And then financial asset is a small part, and within financial assets, deposit is the biggest one. So also the data on financial participation is mostly driven by deposits. So this one is a selective sample and is a bit skewed towards higher deciles. But what we have seen that is perhaps interesting is that between the two groups, the composition of the portfolio doesn't change too much. So even the lower educated group seems to have a consistent diversification similar to the higher education group. And maybe one thing will just be to add deposits and get some sort of like returns on deposits from external sources and look into that. Regarding the other points, like the second one is, if I understood correctly, is I think what we do with the first risk measure, because that one is based on the standard deviation of returns in SHS. So that will basically measure, it's what we call risk, but in the end it's measuring basically these differential in volatilities between countries. And the first point is actually interesting. So I haven't think about that, like how accessible is the investment per se, and whether in some countries it's harder or easier to invest in one or the other one. So it's something that we can look into it. But thank you for the point.
I mean, it's a difficult question, and it's the reason why these statistical standards take 15 years to draw up, but I'll try to do my best, I suppose. I would say that it's clear that the concept of economic ownership is an improvement over what we had before, but it's also brought problems that we would need to reflect on now. I guess the single reporting of by M&Es to a compiler at a supranational level would be preferable, and I suppose the more supranational we can go, given the complexity of these corporate structures, the better. With detailed information on ownership, and then with the ideal, I guess, is with detailed information on linkages. I mean, looking at it from the Irish case, if you think of something like contract manufacturing, you have many countries involved, but when you have the moment of the change in ownership is when the export is recorded as an Irish export. If you're a national accounts compiler in Ireland, there's very little you can do to shed light under the current standards on that. And I think were we to have more detailed reporting by the M&Es on their ownership and their linkages, so we can kind of, to use a phrase used to me last week, to show that the arm is connected to the leg and they're all part of the same body. That would be, I think, the ideal for users. So, thanks.
So it's a mix of changing methodologies and sharing information.
Yeah.
So Giovanni.
Thank you for your questions. We are not actually looking at issuance, and also given that high issuance now will mean future higher payments, but so our analysis actually stops a bit before. In addition to that, it's not that we don't look at portfolio stuff, we actually do. The thing is that I think for emerging market economies, FDI were just more prevalent. Payments, this is not at the stock level, this is just flow of money that derives from that stock. So I don't know if this answered the question.
Gian-Maria, you have the last word.
It's a very relevant question. The lucky aspect of the fact that we are looking at portfolio equity is that this is the one category where this should not be a problem, because a portfolio equity is mostly list stocks which have a market price. They don't have sort of a nominal value that needs to be repaid, as is the case for bonds. And investment funds, which many are ETFs, they have literally continuous time prices. Other have end of day price. Sure, there can be occasional some small discrepancies, but there is just nothing that I can think of in the reporting of prices for this category that would remotely link to the discrepancy. I do think the point you raise is very important when one looks at bonds in portfolios, because you can have a reporting based on the market value or the face value, and I know only of a few countries that report both. I know Argentina is one. You can guess which one is higher. And the second category where the discrepancy, where these pricing issues are absolutely crucial, is FDI, because there, countries literally use different methodologies. Unfortunately, you cannot read the value of an affiliate of Bloomberg screen like you can for portfolio equity instruments, and so there is a discrepancy. I have some theory on where it comes from, but it's just very, very difficult to do this type of granular analysis. Colleagues at the IMF do it for coordinated direct investment survey, but it is, just the US reports something like 5 different figures for FDI assets. You can have, market value, historical cost, book value, and within each you could have whether it's asset liability principle or whether. So it's really extremely hard to reconcile figures very precisely. But I think we are safe on portfolio equities. The nice thing is stocks, and those are overwhelmingly listed stuff.
But you're right, on securities, it's very important, these valuation aspects. We try at the BIS to publish data on debt, public, households, non-financial corporates, nominal, market value, and we are still facing huge gaps, even for very large countries. And it was not the one you mentioned, simply for public. It's a big shit. Okay, I think we covered very different complementary bits. It's very interesting. At least I learned a lot. We learned a lot today. Next session is at 2:15 here back. And I would like to congratulate the presenters because it was very interesting. So